Welcome everyone to the Railroad Retirement Whiteboard. My name is John McNamara of Highball Advisors, and today we're just going to talk about tax saving tools in your tool belt for railroad retirement. You know, things that you can do to just try to save some more money, right? You're working hard, want to reduce those taxes, who doesn't? So we're going to start from my right, work our way over to the left. So the first thing, the best one out there is health savings accounts. If you have access and you're in a high deductible health care plan, you can have a health savings account. And what's great about them is right off the bat is triple tax free. There's nothing else out there that's triple tax free. So what do I mean by that is money you put in comes off your income, the money grows tax free, and then when you take it out, it's not taxed. That's triple tax free. And obviously health savings account, what it implies is as it relates to your medical expenses, okay? So that's a great tool. You can do up to 35 in 2020, up to 3550 as an individual, up to 7100 as a family, and over 55 there's a $1,000 catch-up, which is nice. So that's a no-brainer. If you have the chance to contribute to a health savings account, you got to max that one out. That's a no-brainer because where else are you going to get triple tax free? All right, and everybody's going to have health care issues eventually, right? Next one up is you're all mostly familiar with is your double tax free, your 401ks, traditional and Roth, for your IRAs, your 401ks. Actually, there is Roth 401ks, and 529 saving for college. Okay, so double tax free. So you can either get your tax deferred on the way in, but you'll pay the taxes on the way out, or like with a Roth, you pay up front, and then there's no taxes on the backside. And the other part is obviously growth is all tax deferred no matter which way you do. If you do a traditional or a Roth, your growth is always going to be tax deferred. So that's a double tax free. Once again, maximize that as much as you can. Another great tool for savings. So this probably covers a lot of people, and you should be doing these, looking at these strategies. These are great strategies. We'll get to a little bit more complicated strategies here. These are for higher income railroaders. So the first one is just and I'm going to there's a lot more sophistication behind these, but I just want to introduce these concepts to you people just on a high level. So your Backdoor Roth IRA. For high-income railroaders, can't contribute directly to a Roth IRA, right? Because everybody loves the Roth IRA because all the money that comes out is tax-free. I mean, you're paying you contribute with after-tax money, but all that money after that's tax-free. So that's great. But they can't contribute to it because their incomes are too high, and the IRS says no, you can't contribute your modified adjusted gross income is too high. So what can they do? They can contribute to a non-deductible IRA, and what that is instead of taking the tax deduction, so it's $6,500 a year, you just contribute to $6,500 into an IRA and you don't take the tax deduction, right? You can still contribute into it, but there's no deduction off your income. So you contribute it into there, and then you convert that contribution of the traditional IRA into a Roth IRA, right? You just do the conversion, convert it in, and bam, there you have it. Now the money has moved from the traditional into the Roth, which is where you want it to be for the tax-free income. So that's a great deal. Like I said, there's more to it. All right, then let's go further out here on the spectrum. This is, the mega backdoor Roth strategy. This is very rare, but I just wanted to throw the concept out here because the point here, the first one is the most important one. 401k plan must allow for after-tax 401 contributions. So similar to the after-tax contributions here in the backdoor, it's the same thing in your 401k. So you max out your 401k, and then you say, well, I want to keep contributing to my 401k, but I'm not, it's going to be after tax. I won't get any, it won't be tax deferred. So you can contribute up to $26,000 as an after-tax contribution in 2020. Then you contribute then that contribution is then rolled into a Roth IRA, thereby creating that mega backdoor Roth strategy. And any gains that you've had on that, up to 26,000, that's got to stay in the 401k, or you can actually roll that over to a traditional IRA, and then you're going to wind up paying taxes on that when you take it out. As long, that's just the way it is with all tax deferred vehicles. So these are just 4 steps, very high level. Definitely focus. I love the health savings account. You got to really do those, and then always max these out. And then this is more advanced here, but definitely worthwhile. Just try to introduce some concepts to you where you can save some money around tax time. I hope you found this helpful. Feel free to reach out to me if you want to discuss any further. Check out my YouTube channel, posting up some videos up there. I appreciate the subscribes on that. In the meantime, everyone, please stay safe, stay on track, and take care. Till next time, so long, everybody. Bye.